Bob, talk to us though about this bull market. I'm sure they're as focused on it in Montana as they are here. Do we cross the 20% mark today, and how psychologically important is it?
You know, this continues to be a very quiet, as you say, bull market. As noted earlier in the show, August is usually not a very good month. I think there were a lot of skeptics coming into the month of August, expecting it, A, to be quiet, and B, to be, these risks in the background, whether they be on the trade side or on the monetary policy side. But the markets just seem to be overcoming that, and the earnings numbers really are reflective of an economy that's performing quite well. As we know, wage costs under pretty good control, interest expense under pretty good control, nominal revenues growing again. So I think it's an environment in which we're seeing investors respond to the earnings momentum, which continues to be very good, and still relatively low interest rates as an alternative.
Romaine, Bostick, we are less than 4 points away, but I want to point to your story today, which talks about, caveats to this bull market.
Yeah, I mean, there are a lot of caveats, and I am a little curious, too. I mean, it's one thing to celebrate this, and I think we all should. I mean, we understand this is a long run, but if we're really trying to keep this in the context of history, I mean, aren't there sort of previous bull markets that maybe are getting a little bit shortchanged here?
Yes, but let's go back to an earlier discussion. Here you have, the president at least expressing concern about higher interest rates, and there are some who are already worried about whether the Fed is going too far in hiking rates, yet financial markets are performing extremely well. And so, again, if I have to look at, is monetary policy very tight as reflective in the shape of the yield curve, or is it very easy as reflected in real interest rates? I look at financial markets, and they're telling us that monetary policy in the U.S. and globally is still pretty accommodative. And they're also telling us that the competitive position of the U.S. through lower tax rates, lower regulations, is extremely attractive. And I think that's showing up in the earnings numbers. And for those of us who are looking for even dividend yields and some growth, it continues to attract capital.
So what do you think about the resiliency of this particular bull market, though? I mean, I feel like that we've gone through so many periods where this market should have been down. It should have cratered. It should have fallen. And yet it always managed to, hit a bump and managed to keep going. Can you just talk to me about how much longer do you think this can go? It seems like there's no end in sight here.
Well, markets generally tend to reflect policy errors. And so the question is, do we have policy errors coming down the road? On the fiscal side, I think there probably are some policy errors taking place in terms of future deficits, but that's a medium-term issue. Monetary policy, I don't think we're there yet in terms of being a real constraint on the economy. The one where I do have concerns is on trade policy, and we're certainly going to hear that out of the corporate sector over the next few days as they discuss the implications or potential implications of tariffs. That's where I think the biggest risks are. But again, the question becomes, is this real, or is this a negotiating tactic? And, I think the markets have come to view this as a negotiating tactic, and hopefully there's better news on the other side. That's where I think the disappointment could be, is if the markets get complacent about trade and actually we do have an accident on the trade side.
The dollar index at 95.5 right now, the euro trading at 115.29. Where do we see those metrics going? I mean, obviously it's all going to depend on trade and where trade ends up, right?
It does. I've had a view that euro dollar would trade under 110 this year. We've come a long way. Thought we're getting close. We've had a little ripple here. Obviously, the president doesn't like that trade. But I still think that as we go through the remainder of the year, ECB is obviously on hold through December, and I think will not indicate any prospect for rate hikes till at least mid-2019. And I think the Fed is steadily raising rates, so I still think we get under 110 in euro dollar sometime in the next 3 to 4 months.
What risks are there for emerging markets? What currencies would you be shying away from?
I think the swing country, my former colleague Carmen Reinhardt, I think, wrote a great story about this, had a great interview about this yesterday. The real one to watch is Brazil. Right? The countries that are having problems deserve to have problems. Huge current account deficits, questions about the independence of monetary policy, growth, et cetera. The one country I'd like to keep an eye on is Brazil. I think they are going to be impacted by commodity prices. And the thing that's that's raised a little bit of concern, in my view, in the last 6 weeks is a big drop in commodity prices, and particularly spot prices for raw industrial metals, because they tend to be really driven by the economy. Because they're spot prices and not futures prices, they're less impacted by speculation. And we've had a big retracement in, for example, the CRB index of raw industrial commodity prices. And I think that's a concern. So if there's one thing I'd watch with respect to emerging markets, it would be industrial commodity prices as we go forward. For now, I'm still tilting towards this being a country-by-country problem rather than a generic problem for emerging markets. And that goes back to the fact that I don't think monetary policy in the U.S. is really that tight yet.